Hi everyone, welcome back to my channel, in the money options trading and education, and welcome to today's video. The first item I wanted to discuss from the financial news is the Fed publicly announcing their decision to raise interest rates by 25 basis points, which happened on Wednesday. They also mentioned the need to keep rates high for as long as needed to contain inflation. This was the expected outcome by many market analysts, and we covered this story earlier in the week. However, the market continued to grind higher on Wednesday after the news and again on Thursday. Risky assets like Bitcoin surged even more and have continued their hot streak that kicked off at the start of 2023. As a trader and investor, it's difficult not to feel FOMO at this moment in time. However, the big takeaway from the Fed's decision and subsequent market rally is that investors do not agree with the stated position of the Fed that interest rates will be kept high for as long as it takes. Investors believe that high interest rates are temporal and that they won't be held this high for very long. That contrasts with what Fed Chair Jerome Powell said on Wednesday. The divergence in views was something Powell even called out in his speech, where he chalked it up to a difference in perspective. Clearly, the Fed is hedging against any unforeseen risks that may cause inflation to rise higher, and they don't want to be blamed for loosening monetary policy too early. The perverse effect of this is that if the market does not believe the Fed, then firms may ignore the Fed's signals of belt tightening and may move full steam ahead with their growth plans in 2023. An increase in economic activity may end up causing the Fed to raise rates more than it would have otherwise. That is why it is healthy to have some doubts about the recent market rally, especially in risky assets. In this market, money can still be made without doubling down on risky assets. Another issue at play is that it is tempting to extrapolate the market's performance in January to the whole year, but bear in mind there are still 11 months to go in the year, and anything can happen. The other story I wanted to discuss today because of its relevance to the options market is that of Gautam Adani and his conglomerate of firms. As you may have heard, Gautam Adani is one of the richest people in Asia. What started out as bad publicity has metastasized into a full-blown crisis for the company, and the problems have been amplified by activity in the options market. A major player in the story is Hindenburg Research, which is an American investment research firm that focuses on short selling. They put out a report last week that accused Adani of manipulating stock prices and of accounting fraud allegations. Share prices in Adani's conglomerate of firms have tanked, and yields on debt issued by Adani have surged due to doubts about his creditworthiness. The conglomerate has lost over $100 billion in market value losses since the research came out. Adani has even had to cancel a public offering that was set to raise over $2 billion. The share prices fell in the secondary market to below the public offering price, so he was compelled to cancel the public offering. In the options market, there was a torrent of deep out-of-the-money call and put activity for the February 23rd expiration. This is evidenced by very high open interest relative to normal. When investors buy protection in the form of put options to protect against declines in a stock, the dealers on the other side of the trade must sell short shares of Adani to maintain a matched book that is delta hedged. Don't worry if these terms are foreign, as we will cover these in detail later. As the price of Adani shares falls, dealers have to short sell even more shares to keep a flat risk profile. The underlying problem exacerbates, and the share price drops even more, spurring more investors to buy protection or cut their losses by selling their long positions. This causes implied volatility to jump to extreme levels, far higher than it would be otherwise just given the news. This happens during many significant market events, but I felt it has been particularly bad for Adani lately. The same issue happens in reverse on the call side, and this causes the volatility on the upside to also be higher than normal. For Adani, the imbalance has been stronger on the put side, and the share price has continued to trend lower. However, there are instances in recent history of short squeezes that cause the share price of a particular stock to rise to almost limitless levels. Consider GameStop in 2021 when it had a short squeeze that took the price to over $400. In that instance, traders were buying out of the money call options and dealers were staying delta neutral by buying shares of GameStop, which drove the price higher. Institutional investors who were short had to cover their positions, which caused a massive short squeeze. This case study is useful for us as we analyze financial news and volatile stocks in the market. In the next video, we will return to educational content. I hope you had a nice week and have an even nicer weekend. If you enjoyed this content, please subscribe and leave a comment for how we can improve these videos.